I think this thing's over. And we're probably have 3 years in front of us where markets surprise people to the upside. And maybe even the themes that are leading will surprise people to the upside, because not just tech, and tech looks great, but things like industrials and materials and energy, I think, look quite interesting.
Welcome to the Rose Show podcast. Thank you so much for joining us here on the Rose Show. Today I'm here with David Burrows. He is CEO and CIO of Barometer Capital Management based in Toronto, Canada. So how are you doing today, David?
I'm great, although I'm sad that summer is coming to an end.
Exactly. And it certainly doesn't feel like summer today here in the Northeast. It feels like an early fall day, but I'm enjoying it.
Yeah, well, you know what? All things come to an end. Now we get to work our way through September, October, which I know everybody's looking forward to.
Exactly. I know. And then the winter comes. So I want to ask you, we want to get started with Barometer. You've built up an amazing investment management company. I love your approach, a tactical approach, multi-asset portfolios, and you're looking to seize opportunities while managing risk. And that's what we all want and that we all want to do. So tell us more about Barometer, how it started, how long you've been working with Barometer, and your core business focus.
Sure. So I started our business a long time ago in 1991, and I was at a national investment dealer here in Canada. They were all trying to figure out how to deal with a high net worth client, and built these investment management platforms where they said, we'll get you access to institutional grade money managers you might not get to otherwise. And I remember that sounded like great marketing. The problem was that what I know about private investors is they got a very different set of expectations than a pension fund client does. And I mean, in truth, market goes up 12. If you can generate 12 or 13 and do it with a little bit less risk, everyone's happy. But if the market goes down 22 and you're down 19, institutional managers clicking his heels together to beat the benchmark by 300 basis point, private client wants to kill you. So if the expectation is different, probably process has to be different. And so I've always been a big believer that at any given time, there's asset classes or sectors or themes that have some structural change that's been taking place that favors them, and they valued over a long period of time, and you want to get exposure there. Private investor expects you to find your way to the things that are working. But on the other hand, where the tide is coming in, there's places where the tide is going out. And our client doesn't feel they have to be in all sectors all the time. They don't feel they have to be in every asset class. They're very happy at this point to have, some cash on the sidelines. So I think if you're running money for the type of folks that we manage money for, you've got to be able to pick your spots, and you got to have some process to be able to do that. And most importantly, know when to make your exit, which is, I think, where people make their biggest mistakes. Being a good seller is not easy.
Exactly. And you refer to that as disciplined selling, because that's an important part of it. It's important to remain disciplined. And, tides, like you said, the tide comes in and goes out. There's always rotation going on. What goes up comes back down and it rotates. These are all part of the market cycles. So I love your...
Yeah, I mean, if I could jump in on that, I mean,
Please.
You take any asset class, and I'm going to share a slide there. There we go. That's a long-term picture of the Dow back to 1896. And you'll see that there are periods in light blue where, for whatever reason, asset class wanted a favor, something changed. And it doesn't actually mean that earnings fall like crazy through those periods. It's just multiples compress. In the period between, for instance, 2000 and 2013, where the Dow made no progress, the cash flow in the average company quadrupled, but the multiple compressed. And of course, in those secular bear markets, you better be able to play defense, because the declines, like the tech wreck or like the financial crisis, can play havoc with a portfolio. So it's really important to understand the structural backdrop you're working with. We believe we started a structural bull market in stocks in 2013. They tend to last 15 or 18 years. There are some hair-raising declines along the way, but you have to recognize when you're in a structural bull market. Now, just quickly, if you looked at the last two structural bull markets, this green line is the rising 200-week moving average. So whether you looked at the 80s and the 90s or the period from 2013 on, so long as the markets basically stayed above the 200-week, you come down and kiss it, you've basically stayed in a structural bull market. The thing that people are afraid of is these periods, like the tech wreck or like the financial crisis. It's a very different looking picture. And so, you've got to be careful not to get too bearish in the cyclical declines, because ultimately what comes after them is 3-4 years where you make your money.
Yes, I love that. I want to go right into the market cycles, but what signals to you are key in deciphering that change from the secular bear to bull? Now, you called it 2013. Some say we've been in a secular bull since 81, 82. Others are saying since 2009. Why 2013? What are your key criteria?
Well, look, first of all, you can't manage money just saying I'm in a structural bull market or structural bear market, because either way, you have to pick your spots. There's 2-3 year rallies in a structural bear market that you got to take advantage of, just like there are long rallies in a structural bull market. For us, we assess the market's health based on a series of breadth-based models that we run. So, especially in a world of ETFs where everyone's staring at price is so deceiving, because as we know, this year you take the S&P and you take out the top 6 stocks, S&P has not been as constructive as it would appear, So when I look at a universe of stocks, and we run this process on about 300 universes of assets across the globe, we take every component of that universe and give it a single vote. And we run point and figure charts to assess uptrend or downtrend. And we're constantly tracking, is the percent of stocks in uptrends expanding or is it contracting? Like, we know that early and in advance, a small number of stocks begin to rally, and then the buying spreads. And in a healthy market, more and more stocks participate. There's no bear market in history that ever took place while breadth was expanding. Now, at some point in every run, whether it's shorter term or long term, the percent of stocks that are carrying the index higher will at some point begin to deteriorate. And while it may look like the index is fine, being carried higher by the biggest companies, if there's weakness under the surface, it tells you that your risk reward levels are changing. So for us, the way that we operate is that we track breadth across all these universes, like the NYSE or North American stocks as a whole, European stocks, all the major exchanges, 41 industry groups. And we'll only put on new positions while breadth is expanding. And when breadth starts to contract, it doesn't mean, all hell is going to break loose, but it does mean that our risk rewards change. We'll tighten up the stops that we run on every position. We'll reduce our tolerance for risk and maybe cut down our concentration. And should we get stopped out of existing positions or new money comes in, it doesn't get put to work until we see some expansion in breadth, which tells us there's money getting put to work. So it's very empirically driven. And I'm always interested to hear people's opinions as to why things are happening. But actually, the job of an investor is really just to understand what is happening, and whether it agrees with your opinion or not.
Well said, and spoken from many years of experience. We don't need to question why. It's that incessant urge to see why, but let's just follow price. And that's it. And looking at that broadening breadth. And I know you mentioned that there was a broadening of the breadth from March till July. And you rode that on the way up, and you saw that was a very favorable uptrend that we saw. Now, tomorrow is September 1st, 2023. David, what are you seeing now and the past few weeks?
Yeah, it's really interesting. Of course, things were quite strong into the end of July. And so we have some long-term models that we track, which, for instance, in the NYSE tracked a percent of stocks in uptrends based on point figure charts. And we also run some shorter term models, which look at the percent of stocks trading above their 50-day, percent of stocks trading above their 150-day moving average, percent of stocks trading with positive weekly price momentum, and percent of stocks hitting new highs versus new lows. And all four of those turned down in early August. But interestingly, over the last 8 days are all turning back positive again.
Mm-hmm.
So it's interesting that when June and July has been positive, it's historically you can get like a 2 to 4% pullback. If you go top to bottom in the month of August, it was a little over 5% in the S&P. Pretty typical. But very quickly, last week recaptured the 50-day. A lot of stocks underneath the surface did. We're watching the sector models. Interestingly, the semiconductor sector, which is a real leader generally, was the first group to turn back positive from a breadth perspective after correcting over the course of the month. So there's some very real signs that it may be there's less bumpiness this fall than we would expect. And I know there's lots of reasons to worry about, the calendar and economic data and so on. But also interesting, very few of the key leadership themes broke down. And actually, on the other side, things you would expect to do well if we're headed into trouble are the worst parts of the market.
Yes.
So whether you're looking at staples or utilities. or telcos or any bond proxy, really is showing you where the trouble is. And on the other side, you got industrials and materials and energy, really very strong. So not looking so recessionary. So we really think we're in a different kind of environment than we've been in for years, and people haven't got their head around it yet. We're in a reflating environment, and it's early days. And at the first sign of weakness, people jumped into fixed income all year. Well, they're down money, and that's problematic. On the other side, dividend growth and economically sensitive and reflationary assets perform quite well. So I think there's a lot of repositioning people are going to have to do over the next number of months.
Well said. Now, could you explain what you mean by reflating? That's a new term that people don't toss around as much. They say inflation, deflation, disinflation. Well, reflating. Tell us what you're meaning by that term.
Right. Well, I'll tell you what, I'll show you a picture that is not mine, but I found it the other day and I thought it showed it quite well.
Perfect.
This is a chart from some friends of mine at RBC, and they take that same long-term price chart and look at the backdrop situations that we were in. And the truth is, everybody wants to compare to this inflationary period of the late 60s, early 70s. And they want to say, well, this is why stocks are going to have a hard time. And, I'm fighting some pretty big names in this area. I think George Soros is on that program. Stanley Druckenmiller. But I think we're in a period a lot like after the Second World War. Because there was tremendous amount of debt. The government, actually, debt to GDP has only ever been as high as it is now once, and that was after the Second World War.
Yes.
They were working hard. They were working hard at keeping interest rates down so they could pay their debt. You had a bunch of people come back after the war wanting to be consumers. The baby boom kick off, and at that point, American businesses really went into high gear. You had a inflationary spike right after the war because of all the demand. Rates started to rise. During this period, actually, rates went from 1.6 to 6.6 over that next 15 years. So that's rising rates. bonds gave a 1.6% return per year because you weren't making any capital growth, you're just getting a coupon. And stocks went up 15% a year. And it was driven by dividend growth stocks. And it was at a time when companies that could set price made a profit margin, generated a lot of cash, and then were able to grow their dividends. And I think if we look at the common characteristic that's happening right now, it's companies that have an ability to set price tomorrow, if the demand is there, are the ones that are benefiting. So energy is an example. Some of the materials companies are examples. Paying great dividends, returning tons of capital to shareholders. If we think about it, in a rising rate world, you go from a world where the borrower was in control, and borrower was in control for the whole period between 1981 and 2020. Okay, this is falling 10-year yields. And through that period, the borrower was in control. I think we saw a secular bottom in rates in 2020, or a generational bottom, much like we did in the late 1940s, just before that rally in the stock market. So here's the point. What works during falling rates and what has helped is very different than what works during a reflationary period. Yet we all are trained to look backwards. We've had 40 years to get used to what works during falling rates. And so things, for example, that are helped, real estate, of course, highly leveraged asset. We've got companies like BlackRock walking away from commercial real estate for the first time in a long time, because the cap rate on commercial real estate went from 10 to 2. And when rates go back to 4, you can't have a 2% cap rate, right? You've got to get a return on the capital. Utilities, companies that are highly levered to engineer a return on a thin layer of equity, they're helped by falling rates. Well, if you've gone from a world where the borrower was in control to a world where the lender is in control, you need to own companies that generate cash, that don't need financing, that can make purchases, can buy back shares, can grow their dividend. That's what works in a reflationary world. And it's a very different set of industries.
I love that you mentioned this, because I've spoken about this before, how the 2000s, 10s, and 20s seem to be a quantitative rhyme of the 1920s, 30s, and 40s due to the mass expansion in the money supply. And I think the money supply is something that needs to be spoken about. And now I do also agree that it's higher for longer. It's historically, we're not that high. However, when you come back out of the ZERP and all this free money, there's a lot of pain and there's a lot of rethinking. We need to think different, and the recency bias takes over. People are anchored to this recent past that we've had for the past 40 years, which really, like you said, it marked, I think, the end of the bond bull market. And we've changed now. We're in a new regime, a new time period, and cash is king. And just like you said, how the lender is king now, the lender is in control. Excellent point about real estate. I spoke about this on another podcast about commercial real estate. Cap rates need to exceed that interest rate, and cap rates 2, 3, 4% aren't going to cut it. And there's no room for any profit or you can't rely on equity appreciation anymore. It's a different world. So we need to think different. So I want to come to you now. You, the expert on all this. You've been doing this with Barometer 1991. Let's talk about these sectors that you are targeting and seeing where these high cash companies are, the cash generators. And I'm going to say one, the energy sector. What do you think about that one?
Well, this is, I think, as I spoke to a gentleman I got to know a little while ago, who's one of the most successful pension managers in Canadian history, and he doesn't share his often, but I was asking him, partly to prompt him, where is it that you see value that people don't fully understand. And I've had my view for some time. And as he put it, he said, some of the large resource producers are going to kind of be like taking candy from a baby.
Mm-hmm.
So Canadian Natural Resources, that don't know, is an oil sands producer in Canada. They've got over 50 years of reserve life, and has been. Oh my, there we go. And it took a tremendous amount of capital to put them in the position they're in. So in pink here we have the bear market in energy prices over the last decade.
Mm-hmm.
And during this period, the XOP went down 90%.
Mm-hmm.
But so here's CNQ's share price. Anytime, whether it's an asset class or a major stock, gone sideways in a range over the period of a decade or 2 decades, and eventually breaks out, something's changed for the better, right? We've moved out of a structural bear market into a structural bull market. So CNQ shares break out in 2021. We go through a Fed tightening cycle, which remarkably did very little damage to the major commodities. Like, yes, they pulled back, but really we're very resilient. And here we are, market starting to look beyond Fed tightening and the share price breaking out. So this is a company that pays a 4.1% dividend.
Mm-hmm.
It's grown its dividend over 25% a year over the last 5 years. And there's no reason to think that that's going to stop now. They've been buying back shares. They paid down a tremendous amount of debt. Their capital ratios are at a point where they don't need to pay any more debt down. So they're going to generate something like $9 billion in free cash.
Wow.
And they're going to give it back to the shareholders,
Mm-hmm.
largely. So if you can get a 4% yield with a built-in, at current prices, kind of 20% dividend growth, with leverage if there is a higher energy price, that's a reflationary asset. Another one that I'll highlight is Teck Resources. So Teck Resources, another large cap resource name. And if you look at, in both cases, the bull markets leading into the 2008, they were in the thousands of percent return through the last commodity market. And, this is very, very close to coming out of that same consolidation. Again, dividend payer, the biggest new copper producer in the world, likely to spin out its coal assets, and which makes their balance sheet bulletproof. These types of assets, I think, are very, very attractive.
Absolutely. And IMO, I'm a fan of Imperial Oil. That is one of my favorites.
Well, and that it falls in the same camp. We own that. There's a number of them, but in times where we've seen a little bit more inflation, and in the period after the tech bust, 2003 through 2008, there was a pretty good run in some of the older economy companies. And a bunch of these companies had big runs. But some of the companies that are ancillary companies,
Mm-hmm.
in Canada, there's a company called West Shore Terminals, which runs a West Coast terminal that they ship coal through, now converting to potash. And they effectively get a royalty on all of the materials that flow through that port. So again, it's a dividend payer. It's one where the dividend can grow if price rises or volumes go up. And that's a reflationary asset. Labrador Income Fund is another interesting company. It has a royalty on all of the iron ore produced by the Iron Ore Company of Canada. So situation, they're getting a royalty. If volumes go up or price goes up, they benefit. And I think there's 7 people in the company. It's just a flat business that is a cash generator. These are very interesting businesses for a time like now.
Absolutely. And you mentioned potash. I remember trading that one back in the day. I know they merged with Nutrien. They became NTR now. I remember that. It was like the Canadian companies. And I think it's a great time to be looking at Canada. And we just mentioned CNQ, IMO, and Teck. Those are some excellent companies. So, okay, we have low dividend payout. We want them to retain their earnings, and we want to see an increasing high dividend growth. And those are what we're looking at. We want cash generators, because cash is king. We don't want companies that rely on that constant refinancing and debt, because higher cost of money, higher cost of debt and capital, and that is just going to further compress these margins, which are compressing. So excellent points there.
Yeah, absolutely true. Now, what's interesting is that if also when you look at sort of more reflationary periods, it also is that very often you're going to get some better performance out of global markets than just purely U.S. market. Of course, we know U.S. market has such a big healthcare, consumer sector, and tech, and all great sectors and great secular themes in all of those. But if we look at some of the global markets that have a little bit more exposure to some of these other themes like industrials and materials and energy, it's interesting. I put this up a little while ago. This came from Bank of America, and it's a chart that shows in periods in dark blue where U.S. markets outperformed, and in periods in light blue where global stocks outperformed. And anytime, if you go back over the last 100 years where global stocks outperformed for more than a year, it tended to be that it went on for a period of years. And again, this is one of those structural changes that I think is taking place. We've gone for a long, long time with, for instance, global markets underperforming. And we've moved to a period where, things like, really interesting, Japan underperformed from 1991 to 2021. And then the Nikkei breaks out, and it's been rolling higher ever since. And this is, I think, one of Warren Buffett's favorite places. It's a market that's been trying to create inflation, for years and years and years, and they're finally getting it. And the market's gone through a major shakeup, and valuations are cheap. India is another market that's behaving, much, much better than it has in many years. So another area that kind of benefits from a reflationary environment.
Great. Excellent points there. The Japan and India, we hear a lot about, there's a stagnation going on in the US as well as Europe. And there's going to be a change now. The massive growth in this next cycle is India, and all these other lesser developed countries, these emerging countries, are where to look for the next big growth story. Of course, South America has been talked about for quite some time, and we always like to look down there. I like Rio, and you look down to Brazil, and then now what's happened with Argentina with this excessive inflation, I think 162% or something like that. But there's so many different right, and globally, to look at equities across the globe. So those are excellent points there. I like to say the longer the base, the higher in space, right? So we see, like you said, all these other markets have been consolidating. They've been down for quite some time. So now's the time to look at them as they could be leading in the next cycle. And I love that you mentioned that.
It is interesting. Like people look backwards, and you understand it. People live in their own heads with their own experiences. And so I don't blame anybody for not wanting to buy the dip in bonds, because for 40 years, every dip you bought was probably a good one, except for this one. Going back to that same pension manager I was talking to a short while ago, he said, the funny thing about all these energy companies is they're at new highs, yet no pension funds own them, because they've all sold them since 2014. And talk to the CEOs, whether you're talking about copper companies or nickel or oil producers, they'll all tell you the same thing. Their boards have stopped them from spending any money on new capacity because sector's been out of favor for so long. They just want a return for shareholders. So even the insiders have not been bullish. Yet here we are breaking out to new highs. And that's what makes a bull market in these types of things, because you can't just turn on new copper production. You can't just turn on new oil production. I mean, the shale oil, they were able to, but that seems to be slowing down. And so it's interesting, you know, you just have to look for these structural shifts. And the reason is that once there's a structural shift, you make your money, yes, by growing earnings, but more importantly, by expanding multiples. And if you can get growing earnings and expanding multiples relatively early in a structural shift, it'll go on for years, and you make a pile of money by being in the right neighborhoods. And so this is why I spend a lot of time, you know, on this focus.
Very smart. I like that. Exactly. You want to be there early, and you need to look where the most people aren't looking. And this is a great area that we're talking about. Now, I want to finish up with this cyclical bear market that we've been in. Now, you talk about the structural bull market, but there's little cyclical markets within that
Absolutely.
structural. So where do you think we are with this cyclical bear that we've been in?
Yeah, so you know, we really believe that in the S&P, for instance, October was the cyclical low, and I'll see if I can just throw my chart on the screen here. But you know, if you look at it over time, in a secular bull market, okay, like 81 through 2000, or like 1951 through 66, or like 2013 to the present, recessions were discounted when the market went down 22 to 28% over 12 to 18 months. That's been a typical recession in a structural bull market, like 1990-91, for instance. Okay, so if that's the case, you know, this bear market that we went through, and I'll share my screen here just for a moment. Let's just see if I can find it where I'm looking for. There we go. You know, this is the bull market 1981 through 2000. This is the 1990-91 bear market. You know, it went on for 18 months. And it declined basically right to the 200-week moving average. And ultimately, once you were out, you rallied until 1994. That was a pretty tough recession. There was a lot of savings and loans, you know, got into difficulty during that period, and certainly real estate dropped by 30-40%. If we look at the current cyclical bear market, we basically came right down, kissed the 200-week. We rallied, and every pullback since has pulled back to a higher low. Now, you know, if we look at that on a just a daily chart, you know, we had this whole bottoming process. And when we got to the low in October, the percent of stocks in uptrends actually was better than where it was when we made the low in June. So I always look for a disconnect when you're going through a bottoming process, where the secondary low actually has better breadth than the original low. If we went back and looked at the bear market in 2000, between 2000 and 2003, you know, the market made an important low in December of 2002, made a final low in March of 2003, but breadth was better when it made the low in March of 2003. In the financial crisis, breadth hit its worst point in December of 2008, when the market made its much lower low in March of 2009. Actually, breadth was better at that point than it was in December. Now, the financials took us all the way to the low in the index, but there was a discord in the numbers. So really, since October, we've seen a series of higher lows from a breadth perspective. It was a 27.5% pullback top to bottom. We're now just about 20 months. We're about 5% from the old highs. irrespective of whether we bounce around a bit in September, October, I think this thing's over. And we're probably have 3 years in front of us where markets surprise people to the upside. And maybe even the themes that are leading will surprise people to the upside, because not just tech, and tech looks great, but things like industrials and materials and energy, I think, look quite interesting.
Excellent observations. And I guess it's what we love to hear, but it is what it is. And I love how you speak the truth and what you see. And it's just simple. And I love that you simplify it. And that's the key. You're very objective in your approach. You see right in front of you higher lows and higher highs, and that's key. And then on that chart, it looked like an inverted head and shoulders to me, as well as a cup and handle and the saucer there and everything, right? And it just looked like a nice cup to drink from, nice cut cafe, but it looked pretty clear cut. And I love how you mentioned that second on the right side, it was higher, looked like it was even higher, ready to go up. So those are all very favorable. And then you talk about the next few years, seems like it's going to be a rotation into these higher cash generators, and it's going to be different. I love you look back to the 40s, not just the recent past, but you're looking back further, looking at value, looking at increasing dividends. And now 3 years from now, you think we could encounter a secular bear market again, as the market cycles can show?
Yeah, I think that we're probably in a secular bull market for stocks for another 7-8 years. I think that we'll have
7-8 years.
We'll have more cyclical bear markets for sure. But I think the truth is that we have structural bull market tends to go on 15, 18, 19 years. And we're really only about 10 years in. If you look at the percent gain since the lows in 2013, again, it's really not comparable to other structural bull markets yet. So I think that this is kind of a midway point, a lot like 1990-91 was. And you can look at explaining this a lot of different ways. I've seen some very interesting demographic charts that show how Generation X and Generation Z are into the prime earning years, and will be for the next 10 years, a lot like the baby boom was in the decades of the 80s and 90s. I think that that's very possible. But when a reflationary period starts, it's going to go on for over a decade. And we want to respect that. When people worry about inflation, it would be very rare for inflation to have come out of nowhere and then all of a sudden be endemic. Like in the 50s and 60s, you had a bout of inflation after the Second World War. It receded, and then it came back in fits and starts, and didn't become really entrenched until like the 1970s, late 1960s, early 70s. 15 or 18 years in. So I think that it's likely we're probably close to the peak in short-term rates in the near term. They'll go higher in fits and starts over the next number of years. Bonds probably not a very attractive place to be, and we just want to own things that have an ability to fight inflation, and dividend growers do that.
Well said.
I'll show you one interesting chart that I think I find interesting. This is a chart of taking the dividend growth ETF RDVY, and then comparing it, doing a relative strength chart to FDL, which is the high dividend paying ETF. So we can see from where rates bottomed out, dividend growth really led until we got into the Fed cycle. And once the Fed started really hiking rates, some risk assets came down. But really since June of last year, dividend growth, that's when the S&P made its first low, by the way. When the S&P made the secondary low in October, dividend growth versus high dividend was making a higher low. So it clearly was outperforming high dividend paying stocks. And since then, again, clearly outperforming. So dividend growth as a theme, as an income investor, is outperforming both bonds and high dividend payers. And I think that we're very early in the game.
Exciting. So like you said before, it's not the defensive areas like staples and utilities. And we've seen that they're underperforming. However, it's this other sector, it's this other group of sector and stocks that are cash generators. So let's go into industrials and materials. And I recently met with an international relations scholar who we talked about how the world does now consist of multipolarity. We have multi-players that are interconnected, and every country is like striving for their own independence. So with that thinking, first of all, do you agree with that thinking with the reshoring?
Completely agree with it.
Okay. And so with that thinking, I think that it will cause a resurging in the demand for these materials and industrials. What do you think about that?
Yeah, so I mean, if you think about it, you have the infrastructure bill, which has put a tremendous amount of stimulus in the system. You've got companies vowing they will never get caught again with this supply chain nightmare that they had during COVID. We very clearly have moved from a unipolar world to a multipolar world, and you see what's happening with the BRICS countries trying to expand their reach. And you watch China and Russia and Japan reducing their holdings of U.S. Treasury bonds. Like you can see it in all kinds of places. So we think about all of the goods that come from Eastern Europe, whether it's agriculture or metals, things that we need for electric vehicles. All of this stuff has to be sourced from other places. So there's some obvious places, like you get copper from Codelco, and we can get it from Teck's new mine. But we need a lot more copper for electric vehicles. And if we're going to have more copper, we're also going to need to go find stuff and lift it. So you need companies like Caterpillar Equipment, or here in Canada, Finning Equipment, which is both our holdings at Barometer, because it's the old picks and shovel story. You want to sell the things that they need to get to the gold or get to the copper or whatever it is they're looking for, to the uranium for that matter. You've got industrial machinery companies benefiting from reshoring. It was a great statistic that I saw in the first quarter of 2023. Construction starts on large industrial projects in the US was up 300% over the 5-year average. Okay, we're going to need a lot of compressors from Ingersoll Rand. We're going to need a lot of heavy equipment from Caterpillar. We're going to need a lot of automation equipment, and we're going to need the materials to build all this stuff.
Yes, that's right. And these are very important there. You mentioned the metals, and we talk about copper. Copper is very important, much needed for a lot of things. And the lithium, what is your take on lithium regarding, EVs are going to require lithium? There's a lot of uses of lithium. Are you bullish on that one as well?
Well, it's interesting. It would stand to make sense that we would be. But, if you take the lithium ETF, LIT, it's making relative strength new lows every day right now.
Yeah.
I think that there is a lot of lithium. And, there's a bunch of lithium coming into production. I'm not sure it's so scarce. So I'm a little cautious there. If you said to me a year ago between lithium and steel, you would think logically you'd say, well, steel's ubiquitous, you get it everywhere, and lithium we're going to need. Well, take a look at the SLX; it's making new highs, and the components within it are making new highs, and the lithium ETF is making relative strength new lows. So, forget my opinion. I got to follow the charts, and the charts are very supportive, and frankly, the steel companies largely have paid down debt. They're generating a bunch of cash. Nobody's built new capacity. And again, this is an area that has an ability to set price and benefits from infrastructure and industrial rejuvenation in the US.
Absolutely. Well said. X, that's the company that was it just kept running. And we're like, oh, is there a confusion between Twitter, the new X, or the company steel, right? But it's stainless steel. And actually our manufacturing business is in the stainless steel business. So I've noticed that there's always a demand and high demand for stainless steel products. So it's always about supply and demand, right? Being in economics myself,
Absolutely.
economics, right? And so in the oil market, I believe the supply and demand is very tight. And that will keep, I think we go higher. That's my opinion, that oil will probably go higher from here. I think it's reached its lows because of the supply and demand issues. And like you said, with lithium, there's probably a lot more supply of it, which is probably what's keeping that ETF down, the lithium down. And so it always boils down to supply and demand. And commodities is in a bull market, in my opinion, starting its bull market. I think it ended its bear market, right? In like 2020. Would you say that?
Yeah. And if I've been putting a chart up for a little while on Twitter, and at the risk of being repetitive,
we like repetition. That's good.
I think it's important, to be looking at this stuff. Like, I think that this is one of the clearest charts that you could look at right now to give you a sense from an asset class perspective of where you may want to put money. This is the broad-based commodities index versus the equal weight S&P. And, this is very clearly a bear market in commodities that started through a bottoming process in 2021, broke out of the bear market in 2021, consolidated through the Fed tightening cycle.
That pendant.
And these are monthly bars. So July, August, here we are moving higher out of that pennant formation. The second leg of this thing should be stronger than the first. The first was pretty good. And there's likely a ways to go here. So something just, we all should be keeping in mind. And if you bring this up to 10 investors, they'll all tell you, why would I ever want to own those companies? They're terrible companies and no one's made money in them for years. And it's like, yeah, well, that's why, you can buy some of these things for 4 or 5 times earnings with solid dividends that are likely to grow.
This is exciting. There's so many I always believe there are opportunities in all markets. You just have to look for them and you need to think different. But this is exciting, David. There's like a lot of opportunities here. And it seems like a lot of this stuff is just starting to get going and very exciting. I mean, uranium. What are your thoughts on uranium? It seems like that CCJ, the uranium sector is doing well.
Yeah. I mean, the uranium sector, I think, was one of the great tells. Because if you looked at the way when we got this first move higher in the materials, and this is say in the month of July, after kind of being quiet for a while, throw that back up there. If you look at what happened to Cameco, like at the very start of the strength in July, Cameco came up and out of the range on day one, on the first day. So, they say the first stock to double is the first one to double again. When you see a group turn, you don't want to buy the laggard, you want to buy the one that's behaving the best. Because if something's been doing well during a period where the sector's had difficulty, take the lid off it, it can probably pop higher like a cork coming out of water. And I think that was very, very telling when Cameco lifted right off the bat. And, if you take the URA ETF, Cameco is not on its own. It's certainly acted better, but the URA ETF is acting quite well also.
Absolutely. It's CCJ in the US and the New York Stock Exchange.
CCJ, that's right.
Yeah,
that's right.
CCJ, and that's a great one. And so we did the top-down approach. We looked at the markets, we went down to the sectors, and now bottom-up approach, which I love doing as well, very important. And we identified the leaders in these great sectors that are starting to go up and are showing strength. So we talked about CCJ would come out chemical with uranium. We have the oil companies we identified, and in tech. And I think that we briefly touched upon tech, but I think that's an important one to talk about with equities, because the GPU is so needed. The semiconductors, NVIDIA is key for that GPU for high performance computing, Bitcoin mining. We know the demand is there. Their earnings were good, and they had great buybacks that they announced. And, you know, fundamentals matter, and that demand matters. And then SMCI, it's one of my long holdings. I think last April of 22 was when I identified it with the low, it was a low multiple. And we said as a joke, we're like, you know, it's masquerading itself as a value stock, yet it's a growth stock because it's grown significantly, a great company there. So what are some other tech names that you are interested in?
Well, you know, if you think about it, in the early days of AI, it's again picks and shovels, and that's why NVIDIA is acting as well as it is, and the clear leader.
AI,
and James Callahan, who worked with us, really beat me into submission early this year when tech started to turn, to put on a position, you know, to his credit. Going back to the theme that we want to own companies that are big cash generators, really, I think if you want to, we don't know who the long-term leaders are going to be in AI, but we know who the likely participants are going to be. So, you know, you gotta look at Microsoft and look at that cash generating machine and say, you really have to participate. They have data. They've got all of these multiple business lines that AI, you know, will be applicable to, and you've got these giant subscriber bases that you know are going to demand it. So certainly Microsoft, Adobe is another, you know, in the creative area. There's multiple use cases, and they've got the cash to invest to be there early. You know, we talked about NVIDIA. You got to talk about sort of Apple in the same way. Again, cash generator, dividend grower. Now, you know, I have a hard time squaring the circle sometimes with some of the highest multiple stocks. You know, NVIDIA is a very expensive stock. It will attract competitors into the space if there's that much money to be made. You know, we're going to see competition from companies like AMD. But at this point, you got to go with the leaders. And so really tech for us, we actually are somewhat underweight tech. Now, when you say somewhat underweight, I think we're like 23%, something like that across the firm. But really, we are focused in large cap. I have a hard time seeing how some of the ARC innovation type businesses are going to maintain their multiples if they're not generating the cash to support it. So really, it's the large cap. And in fact, if you look at the TDIV ETF, which is the Tech Dividend Payers ETF, it's an interesting list of companies because they're for the most part all dividend growers, and there's a bunch of cash generation in there.
Absolutely. Well said. Microsoft and Apple, right there, you have those. And, you know, Microsoft Bing is fantastic. My son, being in computer engineering, always says that he prefers Bing. He thinks it's a great program and platform. And he says the one to watch is Microsoft. He's not as much of a fan of Google, but he says Microsoft is great. So those are some excellent names that you mentioned there. And I think those are ones to watch. We don't know what the future holds. We don't know what the emerging leaders are, but we certainly know the sectors to be watching closely. And I think AI is like an industrial revolution. It's a whole new level in the way we work and the way we live. And I think it's going to create new jobs. I think we just need to think different. It's going to eliminate some, and then it's going to modify, and we're going to have different type of, you know, society, and it's going to elevate things. And I think it's we're just going to have to keep our eyes open for those opportunities, because there will be plenty. And I think they're starting to sprout now, as you so clearly pointed out, David. I want to go into your tactical approach, which I love. And it's so important, the discipline selling you talk about. And then objectivity is key, because there's so many human biases that occur. And like you mentioned, the recency bias, the anchoring, people are just so accustomed to doing things a certain way in the past, 10 years and 40 years, like with the bonds. So tell us how you remain objective.
Well, so as I mentioned, we run these breadth-based models. So I run one for each of just over 40 sectors. And so at any given time, there will be a certain number of sectors that have been showing expanding breadth, which that's sort of our hunting ground. Where we see deteriorating breadth, there may be great companies and we may own some, but we're not adding anything new. When a group has been out of favor for a long period of time, you might get to a point where 6 or 8 or 10% of stocks in the whole universe within that sector are in uptrends and behaving better than the rest. First of all, it's never a fluke. There's a reason why. They're doing something right. They've got a good product. Something's changing in the business. Smart investors, probably smarter than us, have identified them early and are early buyers. So when we do see the breadth models turn up from a low level, we'll always go to the strength. Now, we run top-down models, those breadth-based models. We run bottom-up models looking for companies with characteristics that point to the fact they're going through a positive change. So we look for about 20 characteristics in the income statement and the balance sheet that point to acceleration in the underlying business. If revenue's up 6% one quarter, 8% the next, and 12% the next, something's changing for the better in the business. And you better take a good look at it and try and understand why that might be. So I use a simple example. In November of 2002, Apple, if you can believe it, was $3 a share. In March of 2003, when the market was making lows, it was trading at $6.50. It had doubled. Turns out this iPod product was a pretty good product. Now, ultimately, you could see it in the numbers. That product was taking off. And even though people were as bearish as you could possibly be in February and March of 2003, Apple's doubled. Well, there's always companies like that, and that's an extreme example, but companies that are just behaving better than the rest. And so when we see breadth start to improve, we go straight to the strength. We'll start with a half position. If it starts to work, and we always identify a stop price below the price we paid. If it starts to work, we'll add to it on strength. We don't add on weakness.
Mm-hmm.
And if we get to a full position at 5%, we'll say, well, what else is there in the group that looks interesting that maybe we want to add to? And that's how we will start. Now, when breadth turns up, when only 10% of stocks are in uptrends, I guarantee you there's no momentum investors putting money to work at that point. It's way early. But we want to start with something. And then as strength builds, we'll add. So in a great example, early this year, the home builders, against all odds, in the face of an expected recession, start to relatively outperform. So, we started with a position in Lennar. We wound up building into a position in D.H. Horton. And then we built into a position in Century Communities. And it's still a group that people are having a hard time understanding, given what's happened to mortgage prices. But it's a group that's outperformed all year long and is about as strong a group as you can find in the market beyond, the obvious NVIDIA. So breadth means nothing more than money is being put to work. So I'll say it again, we will not be the smartest ones to buy something that's universally hated and be the one to pick a turning point. But I want to recognize when something's changing for the better. Just like late in the cycle, I think back to 2014 with oil at $150 a barrel. My partner at the time was from Calgary. It was an oil town. We had a lot of energy exposure, of course, because fracking had been a great theme to be focused in. and the breadth model started to turn down with oil at $150 a share. He was going on vacation. I said, I think we got to lighten up our energy weight. And he said, Dave, energy's at $150 a barrel, probably going to 200. I said, well, I don't know what's happening, but breadth is starting to weaken. So he went away on vacation and came back a week later and said, where'd all our energy positions go? But, it was just very clearly over. So you just have to have some tool to recognize those structural changes. And that's what we use.
Love that. You keep it simple, and that's key. And I think it's very smart how you do it. You ignore the noise, because if you're watching what's going on in the news and all that extra noise out there and going on in the economy with the housing market, you would never even think of looking at the builders. And you definitely wouldn't be investing. And because you're watching these charts and you're seeing this breadth, you were able to seize those opportunities and make money in the home builders, which no one would have thought that they would have run up. So, and the market doesn't.
Well, I was going to say, after the fact, as you get into it, you start to recognize why. Of course, in the U.S. as it is right now, with rates doing what they're doing, nobody wants to walk away from a 30-year mortgage at 2.5% to buy a new house. So there's such a short supply of existing homes on the market. The home builders are the ones that are able to supply it. But it wasn't intuitive to think of that at the beginning, but clearly, something was changing there.
Absolutely. And the market is a leading indicator, while a lot of the data we have is lagging. And so the Fed basically locked people in their homes with these low rates. But a concern that many economists have, and including myself, is that if we do enter some type of recession and there are job losses that go on, doesn't matter what type of rate you're locked in at, if you can't pay your bill, you can't pay. And then with commercial property, all those vacancies in the office, as well as now, multifamily, there's a huge supply, a lot of headwinds going on in that market. But you know what? You follow price, and that's key. Being a tactical trader, as you are, you seize those opportunities with that, and you ignore the noise. And that's the key here. I love that you simplify. And you know what? Another point that you make that I really love, and I think everyone needs to hear, you don't have to be in everything. You don't have to have everything, right? You just need to have a few that work, and you make your money. Tell us about that approach, how you simplify.
Well, if you think about it, really, all you need in a portfolio to have a diversified portfolio is with 20 or 25 positions. And in a given year, if we put on 25 positions, I can tell you, every year is a little different. But the math is going to go like this. 2 or 3 are going to work out way better than you expected. Something's changing for the better. Sometimes it's changing for the better faster than you thought. And that's why we use stops, because we don't pick an exit. We ratchet stops up in behind our existing positions, and we'll stay with them as long as they work. And some just work way better than you expected. 7 or 8 are going to be okay, and a bunch aren't going to work. So in managing money or managing your own portfolio, your success is tied to holding on to your winners and not getting emotionally attached to the ones that don't work. If you think about how people are wired, nobody likes to take a loss, and people love to take a gain. So we're wired the wrong way. People sell their winners and hold their losers, and pretty soon they got a portfolio that looks like the dog pound. And the truth is that if you use stops and you stay with your winning positions, it's how you make money. So it's just really important to have some tool, some discipline to take you out. So at the stock level, we use stop losses for that. We start every position with a price below the price we paid, where if we cross that line, we've used up our risk budget, we're going to the sidelines. From a sector exposure or market exposure standpoint, we use the breadth-based models to help us target. And when breadth turns down, it tells us as the tide started to go out, we got to start reducing our weight, and certainly not add any new positions in that group. And then we do the same thing at the asset class level, which is what's put us into things like energy and materials currently, after a long period of not being in them, like years and years. And similarly, we had a position in Nextera in the utilities, which has been the highest growth utility became the largest utility in the U.S. It's outperformed for years. They've got the highest percentage of unconventional energy, wind and solar. Yet thing rolled over this year with the group, and without a stop loss, you're down a lot of money. So it's just, you got to have rules.
Exactly. And I love how you mentioned that you scale in to strength, to winners, to ones that are in an uptrend. You don't double down. You don't go and you cost average down and add to the losers. Rather, you take those small losses if they hit your stop loss. And it's like you trend follow. Would you say your strategy is like a trend following strategy?
I'd say that, but the important point I want to make is the difference between what we do in a trend following strategy is our entry points into sectors tend to be way before a trend follower or a momentum investor would start to buy. An improvement in breadth does not mean that the index is already looking good.
Mm-hmm.
Right. So if you were to look at an ETF in a sector that's been out of favor, it may look horrible, but there might be a couple of components that for some reason have started to behave much better than the group. And that would cause us to start putting on a position in that sector. And then similarly, breadth will break before price will. So again, if you're following an ETF, the breadth or the percent of stocks advancing within the ETF will start to deteriorate before the price of the ETF actually does. So there's a fine difference between the two. I think it gets us in a little earlier and gets us out a little earlier. Now, there's upside and downside and everything. We tend to outperform during a prolonged decline because we'll get defensive and won't put new positions on, and we'll just wait it out until we see some clear evidence of positive change. And so that's great. And so private clients tend to really like that risk management. On the other side, when a group gets going, we tend to get there and stay there and take advantage of the move. And that's a real positive. The most difficult time is during transition periods where maybe there's a wrestling match going on in the market over a specific theme, or even more over an asset class. And so I would say, for a lot of investors, 2018 through 2022 is a very tough period of time because you had this big shift taking place in interest rates. Rates likely were starting to bottom out in 2018, and then COVID, of course, sent them to the lower lows. And there was a lot of back and forth over that period. So the tough part about being tactical is in the several month periods where you're seeing transition. It can be a little bit of a meat grinder, but ultimately you get paid when things get into gear.
Very nice. I like that. Thank you so much for explaining that. Very important. So you get in earlier, but then you can leave the party a little early. And there's an expression that I like to use. It says it's better to sell too early than to sell too late. So I guess that works with your strategy quite well. But yeah, early to the party. I like that. That's great stuff, David. When you talk about diversification across asset classes, we talked about equities and we talked about some fantastic Canadian stocks and some, we also talked about ETFs. Do you also diversify across asset classes and trade futures, or do you do any managed futures or any of those type of positions?
So interestingly, our clients are largely high net worth families and folks that have built businesses. They don't tend to be sophisticated financial engineers. They don't tend to understand derivatives markets as well. We do participate in multi-asset, long, short, but actually we use ETFs to express it. So there's such a wide variety of ETFs. Really, there's only about 18 major assets that you can trade, for instance, futures on. But you can get much more granular using ETFs than you can with futures. I mean, we can get into very specific themes, very specific sectors. Of course, you can get to very specific geographic regions. So you can trade currency, commodity, real estate, global equities, domestic equities, multiple market caps, all just using ETFs. There's nothing scary, nothing nothing too complicated, and you can manage risk very effectively because it's all very liquid.
Yes, I agree. There's an ETF for everything nowadays. I mean, it's just amazing what you can do with the ETFs out there. There's just so many of them. So agree on that as well. So what are your thoughts on the dollar? Now, we've been talking about how commodities are gaining strength, and it looks like they could be in a multi-year bull market. Now, they tend to be inversely related with the dollar. So are you seeing there's the dollar right now is about 103, and it's been on a downward slide since October. So what are your thoughts on the dollar?
Yeah, so I've been quite bearish on the dollar. And I will say we are at an important wrestling match, sort of an inflection point right now. If we look at it, dollar, let's see if I can just throw it up here on the screen, because I do think it's important to watch. Here we go. So, there's a weekly. Let's take it down to a daily. We have had a series of lower highs and lower lows. Although this recent rally has taken it back to the 100-day, the 200-day, and the 150, 50, and 200. So the question is this a change? And I think that it's really important to watch. And the moving averages are still moving lower. I think the next month is going to be pretty important. My guess is we likely are going to put in another failing high here, but that remains to be seen. We're headed into September, October. There was huge bond issuance this past month, so that means a lot of people had to buy dollars to settle those bond transactions. We're just at month end here today, 15 minutes away. And so it will be really interesting to see how the dollar trades early in September. My guess is it continues to weaken. If you look at what's happening with global markets, you look at what's happening with commodity markets, these are things that tend to do well with a weaker dollar. My guess is this bounce in the dollar since July, the counter trend move. But this is an important price point we're at, and I guess we'll learn a lot more over the next few weeks.
Absolutely. Exciting times, for sure. But, I want to ask you about the risk-free rate right now. I think the 3-month T-bill is about 5.5%. Many people are saying, oh, you can keep your money there. I mean, it's much higher than the earnings yield of the QQQ and the SPX. Are you having any portion of the asset portfolio in T-bills, any short term on that?
Yeah, I mean, we have about 10% right now in short-term debt, like up to 1 year. Part of that is having a little bit of cash heading into September. Part of that is that the longer term breadth model showed a little weakness through August. And part of that is, it pays us a little bit to have it. I just really look at it as cash waiting to get put back to work. So, I had a client come in this past week, and he said, okay, so let's go. I said, great. I said, we're going to put a third of it to work today. We're going to put a third of it to work in the 4th week of September. We're going to put the other third of it to work in the 2nd week of October. I'm not going to fight the calendar. Now, when you look at it the other way, are we putting it there because we think that the return is good and it's going to be? I don't like fixed income, period, right now. I think that it's going to be very hard in fixed income over the next number of years. I think that we will see yields move up and move down, and there'll be short-term rallies, just like in a structural bear market. In any asset class, you can pick your spots. Truly, if you look at the yield you get, say you get a 4.25 on a 10-year, after you pay tax and inflation, there's nothing left. And our job is to make sure that we're helping people, stay ahead of inflation. And so we're going to do that with dividend growth securities instead.
Yes, and with a tactical approach as well. So I like that.
Yeah.
Exciting stuff.
Yeah, I will admit, we've been short the bonds through the course of the year. We covered our TLTs, which are the long bonds, but we are short the aggregate bond index currently in our macro strategy, and we're short the municipal market, and we're short utilities, and we're short staples. So that's our positioning as it is right now. We think that's the most unattractive part of the market.
Some great calls there, because that's exactly the pattern that's been going on. Long-term rates are creeping up now, and they backed up a little bit from last week, but then nothing moves in a linear path. So it looks likely that they will continue higher. And as rates go up, we're going to have risk premia increase, volatility is going to increase, and liquidity is going to decrease. And that's why exactly your thesis, how cash is king and the high cash generators are key, the ones to watch for this next upcoming cycle that we're in. I want to talk about the macro and the Fed. We had some words from Jay Powell recently, and he says he's going to keep at it until he's done. Very hawkish. Core inflation appears to be entrenched in the high fours, 4.7, 4.8, around there. And it seems to be rising month over month, 0.2%. Headlines come down to 3.1. But the money supply overall is shrinking. M2, we have, credit crunch going on, lower lending overall, lower supply, lower demand, like we discussed earlier. So there's a lot of talk of a recession being baked into next year. What are your thoughts on all of that? And what do you make of it?
Well, first of all, we're going to have to watch what he does, not what he says. Right? Part of his job is to use the bully pulpit to make his point and help drive down, inflation expectations. So right now, I would prefer to watch what the market is saying, and the market is saying that he's done. It's why a bunch of these risk assets have started to lift over the last 6 weeks out of the range that they were in while he was tightening the cycle. I do think that we are into a period of inflation in fits and starts. I think in some areas, inflation is dissipating. In others, it's not going to dissipate. I think, things like commodity materials are likely to be a headwind, and energy is likely to be a headwind. Things that were just supply chain related, they're repairing themselves. Used cars are coming down in price. Certainly a bunch of the stuff you couldn't get, you can get now. There's no shortage of chips. So in some areas, you're seeing inflation come down. In some areas, I think it's going to be a little bit tougher. So what do I believe? I believe that we are going to be higher for longer. There will be little bouts of weakness in the economy that bring short rates down. We're going to see multiple Fed cycles over the next number of years. But I want to make sure that I'm in the assets that benefit from the current market environment. When people say the risk-free rate versus the S&P's dividend, well, it's like saying if you put your head in the oven and your feet in the freezer, you get an average body temperature. It doesn't make much sense. You got a ton of companies that don't pay a dividend and trade at high multiples. That's probably not great. I wouldn't want to really own a ton of that. There's some companies that pay high dividends, but that don't grow. They're not that attractive. But it's that middle tier where companies are paying a decent dividend, but with like dividend growth in the teens and low dividend payouts. That's really attractive in this kind of world, I think.
Absolutely.
So the macro picture, it wouldn't surprise me if we saw some economic slowdown in some areas. I'm not so bullish on the consumer. If I look at, for instance, the way that the PEJ ETF is trading, that's the leisure and entertainment ETF. It's behaving poorly. Some of the areas of retail are behaving poorly. They're going to get squeezed by rates, but the industrial companies are not going to get squeezed by rates. They don't need capital. They're generating lots of cash. you just have to pick your spots, and remember that the market is not the economy.
Well said. I love that. You made an excellent point how it's not about the average. When you compare the risk-free rate with the earnings yield or dividend yield of the SPX, you cherry pick them. You find the ones, you go through the data, the fundamentals, and you find the high dividend generator, the cash generator. So when someone talks about the aggregate and the total, it's actually not the whole picture there, and you can actually cherry pick them as you've done with choosing those leaders and those high cash generators. Excellent points there. And the market is not the economy, and that is the key point there. There's always a bull market somewhere. I like to say that, and you've certainly found them, David. David, please tell our listeners how they can follow you and find out more about your investment management.
Sure. So it's interesting. Years ago, we decided that if part of our strategy is to be very specific in process, we better show people that we follow it. And so I started years ago doing a weekly webcast, which I do every Tuesday afternoon at 4:00. I post it on my Twitter site at Barometer CA. And we post it on our website, which is barometercapital.ca. And so I try and follow it up with regular posts on things that we're seeing taking place, observations. And so the Twitter site is a good one, and our webcast, which we post a lot of insights. And we're in the business of taking care of families who are looking for what we do. And we're always happy to have conversations with anybody who'd like to speak to us.
Thank you so much, David. I've really enjoyed our conversation today. You've really shed some amazing light on the markets and your amazing strategies, and your view and your perspective has been fantastic. Thank you so much.
Thanks for having me.